everyone. This is Abhijit Chatterjee. Welcome to our weekly session of Chartsarefun. This is for the week of January 13th, recording this on January 20th. Well, the market reacted quite well to the inflation data. Last week, we had two key CPI and PPI prints. Both were tame. Market was expecting 0.3% month over month. We got a 0.2. Market breathed a sigh of relief and rallied back. We know that there was significant concerns of a market breakdown. People were looking at a head and shoulder breakdown of S&P 500, people projecting down to a test of the 200-day moving average somewhere on the 5560, 5570 level. And market did fill the gap from the election early November gap. S&P filled that gap and then started rallying. And it had a very key reversal, we would call, of S&P and the key barometer of market breadth called the Summation Index. So today we'll look at the Summation Index, see how that is indicating perhaps a turning point. We know that Tom Lee had talked about a turning point. We know that there's been a lot of bullishness from the firma bulls out there. Tom Lee seems to be very bullish. We know that there is folks that are like Gene Munster and folks like the perma bulls who are very, very bullish on the market, expecting the market to, Dan Ives is the other guy, expecting the market to at least have another 2 years of this AI-powered bull run. So we'll look at today, the key part of what we'll do is look through the spiders, which is the industry sectors. There are 11 of those. We'll look through them and we'll see what are their trends, what are they saying about the market. With that, let me share the charts. So we request you to look at our blog site. It's in Substack, chartsarefun.substack.com. If you subscribe to through an email, you'll get the blogs as soon as we publish it every day. We also have our YouTube site, which is also called Chartsarefun. That's our channel at Chartsarefun. If you subscribe to it, we will send you the you'll get the recordings. And if you do like the videos, we appreciate you hit the like button. You can just subscribe to it and get to get these videos as they get posted every week. I said we're going to talk through a key barometer of the market for market breadth called the Summation Index. This is also a cycle indicator for the market. So if you look at the last almost 15 weeks, we can see a steady drop of, this is two key summation indexes. We have one for each of the exchanges, NASDAQ and New York Stock Exchange. In this one in particular, we're looking at the NYSE or the New York Stock Exchange from a high near 1100, 1112 on very early October. For 15 weeks, it has come down. And we can see with the candle here reversed finally higher at testing a very key ascending trend line. You take the bottoms from October 2022, October 23, and then the bottom that we got last week. It has just reversed higher with the candle that we printed on the Summation Index engulfing the last couple of weeks of candles. This, as you can see, is oversold on the MACD. You can see significantly down on the MACD and on RSI having dipped below 30, just turned higher. Typically, when you get these down cycles and up cycles, that's how you call these as market cycle indicators. You get several weeks of down cycle and then several weeks of up cycle, several weeks of down cycle, and now we're expecting several weeks of up cycle. We may not get like up cycle here, which went, this is a weekly chart, every candle is a week, which went on for 1, 2, 3, 4, 5, 6, 7, 8, 9. Possible we could get in the next 8 to 10 weeks of upside, and that could mean markets breadth improving. Small caps could do well. We could see RSP, which is the equated S&P 500, doing well, and we could see overall market breadth improving with more advancers than decliners. That's how this index is calculated, the Summation Index. It's a McClellan Summation Index. It's a net of advancers minus decliners in the New York Stock Exchange and cumulatively added. So it typically cycles between 1100 to minus 1100. It really goes to minus 1100. The deep oversold was in 2022 bear market. That's when it did hit 1100. Since then, it's been higher lows at minus 834. And recently, it rallied back from minus 435 is where we saw was the lows of the week. So it's indicating a market reversal at hand. S&P 500, which is kind of the barometer of the US markets for the 500 top stocks, had been declining on call it a bullish flag. Why? Because we had a very steady climb from August of 5119 to 6100, almost 1,000 point climb. From there, we got a kind of call it a declining flag pattern, but this is a bullish flag because it didn't pull back as deeply. It tested from the top of the trend line to the bottom of the trend line. You can call this as an ascending channel. Join the higher highs across this last 7 months and then the higher lows. And we can see that it pulled up from the top of the trend line to the bottom. So from 6,099 to 5773. We did fill this gap from the election. This is the gap that it left after the election results were announced. And now we tested this trend line and have been climbing. This is just about broken above the bullish flag. So we can see the upper and the bottom trend line of the flag. It just broke above that on Friday. We have to see what the continued momentum does for the next 8 to 10 weeks. So my projection is that we have a continued climb, a few pullbacks here and there, but that's the destination back to the top of the ascending channel trend line, which is closer towards the 60 to 100 plus. That's where we expect the market to head in the next several weeks, in the next couple of months, I would say. So that's what the S&P is saying. We can see a classic positive divergence as the S&P was pulling back from the mid-December to the last 6 weeks. We can see that the MACD histogram is printing higher lows. So that's an ascending, like higher lows on the histogram is a positive divergence as an improving MACD while the market pulled back. And now we can see that RSI is crossed above 50. It's at 55. It's about to start climbing again to climb higher highs in RSI. We can see that MACD has crossed. The black line is above the red line, indicating that MACD can now have a crossover, a bullish crossover. We can already see on Friday the MACD histogram that printed was positive above the zero line. So for next several weeks, couple of months, we could see this MACD histogram move positive, MACD climbing and RSI climbing, taking the market higher to this top trend line. So that's the projected expectation. Now let's look at the 11 sectors. Energy by far has been the strongest in the recent few weeks. We can see that from around December 18th, when FOMC did the decision, the energy sector has been responding extremely well, climbing up from where we saw RSI deeply oversold below 30, almost near the 2020 level, climbing above 70. 73 was the recent. That's the strongest sector in the last 6 weeks. Energy going up a very steep channel, as we can see, climbing to the top of the channel, slightly pulling back late December, and then kind of the last couple of weeks steadily climbing back to the top of the channel. A very steep channel, destined to kind of go and retest the November highs around 97 is what we expect the energy sector to do. We can see strong accumulation distribution from a pullback in the early December, December 18th. We can see AD climbing. We can see relative strength also kind of climbing over the last couple of weeks relative to S&P 500. So relative strength climbing, accumulation definitely, AD climbing, MACD improving, RSI at higher highs above 70 indicates strength in the energy sector, which means potentially we could expect it to retest the November highs. The next strong sector is financials. This was actually a beautiful double bottom. So you can see a bottom in December at 47.39, a recent retest at a slightly lower bottom than 47.39 at 47.03, but classic positive divergence. When it retested 47 at a lower low, RSI was at a higher low. Same thing with the MACD histogram. So this is positive divergence again, double bottom at 47, reclaimed the climb since then. Energy had a very strong week last week. We know that it gapped higher after strong earnings from JP Morgan. We know that JP Morgan, Wells Fargo, Goldman Sachs all had great earnings, and so did Morgan Stanley. So across the board, strong earnings in the financial sector, Citigroup, and that basically after gapping higher after the Tuesday's earnings, last 3 days, Wednesday, Thursday, Friday, it kept climbing higher highs. So We can expect this to retest the November highs around 51.4, and the energy sector looks bullish for the time being. Industrials have a very similar pattern like the financials in terms of a double bottom. 131 tested twice, 131 from 15 in December to 130.45. So again, a lower low from the December low, but at the same region around 130, 131, which if you look at the 130.5, that's kind of a support level. And we can see classic positive divergence, higher lows in RSI, higher lows in the MACD histogram. So with that positive divergence, expecting this to be a double bottom climb, back retesting, perhaps a move back to 143.79 in the November is what we would expect the industrials to do. The utilities, we know that have been a defensive sector. It also has a beautiful, very similar kind of double bottom around 74. 74.09 was the December low, 73.91, a lower low from here, but a higher low in RSI, higher low in MACD histogram. That's how bottoms form. So a double bottom there as well in the utility sector. Took out the W part of the double bottom at 77.49, at 78.8, at tested 79.2 on Friday, expecting further climb on the utilities towards the 82. We'll see how the earnings come out. We know that the utilities have been beneficiary of AI spending, AI expansion in the data centers. A lot more electricity consumption has been helping the sector quite a bit. So besides just the defensive in nature and tends to be dividend-seeking customers on it, they've been getting some secular growth with AI spending and hence insatiable demand for electricity in the data centers. So utilities look strong, a nice W-shaped double bottom, expecting further climb to retest its November highs near 83, 82.7. The sector that has been extremely well after the August low, we know that the August low came around the early August when Japan had a market crash and the market pulled back. From that August 5th, we can see a very strong, nice parabolic climb in the discretionary. This is where Amazon is, this is where Tesla is. In particular, we know that Tesla has done outstandingly well over the last 2 to 3 months since actually after the election results and actually after their earnings in October when robotaxi became more of a reality. Customers are extremely the analyst and the Tesla shareholders are extremely bullish about their AI prospects. This being more of a automated driving, self-autonomous driving car, and the opportunity for them to leverage that, and also their robots that they're going to start manufacturing, things that they use in the factories, but to be commercialized externally. This discretionary had also a bullish flag pullback. We can see the channel right here and broke above the channel. So the top of the top, like the declining tops and the declining lows, and it just broke above the top trend line of the declining tops in the last 3 trading days of last week. So that in many ways, we expect this to be breaking out of this channel to an upper climb back to retesting the December highs near 240, 239.83 was that high. We closed about 229.2. We tested 230 on Friday. So another 9 to 10 points is what we expect the utility to, the discretionary to climb over the next couple of weeks and next couple of months actually. And part of it is the earnings is going to be coming out. We have Tesla coming out next week. We have Amazon after, and all these are discretionary stocks that can help this sector climb further. Communications is where all the internets are. They tend to do extremely well in January. So we have Meta, we have Google. All these are big parts of and so do you have Netflix of the communication sector. Their earnings are going to be coming out in the next couple of weeks. We'll see how the market responds to it. This is also a declining channel, but in many ways a bullish flag after the huge climb from 80 to 102 over the month from August till December. And then a kind of a bullish flag, breakout higher is about to happen, hasn't broken above the descending trend line from the tops, but 102.99 and then close right below that at 97.3. That break is expected next couple of weeks and continued climb back to retest 102 is what we expect. And then from there, perhaps kind of a cup from 102 to 94 to back to 102, and then maybe a breakout from there is what, if the market has to break out with S&P climbing back to 6,200, there's a good chance XLC perhaps could print a slightly higher high above the December high. Technology we know has been a bit of a dampener. NVIDIA in particular has pulled back. There was a lot of bearish chatter on NVIDIA. Apple has pulled back quite a bit, fears of their growth, fears of China valuation, everything else. So technology sectors have seen some pullback, but even Palantir, kind of the darling stock for Wall Street, a big beneficiary of AI spending on the software side, had pulled back from touching 80 to the low 60s recently, and since that is trying to recover. But this is also flag, but kind of a declining channel between the tops and the bottoms. It is not yet crossed the top part of the declining tops. That is just below it, but the expected level of that is somewhere close around 234. So somewhere around 235, it'll cross it and could keep climbing back to retest that 241.57, the December high. There is weakening momentum here. We can see as this happened, MACD is kind of pull and the PPO is pulled back, kind of testing the center line around zero. Accumulation continues to be strong, very strong accumulation towards the highs, and relative strength has been declining relative to S&P 500 from around the flat line at 0 to negative 2.3 in the last few weeks, last couple of weeks. So we would expect technology to take the leadership, not as much perhaps as the other sectors, like maybe the financial industrials or the energy, but maybe with any decent earnings coming out from the trillion-dollar club members. Like NVIDIA comes out a lot later in February, but we can expect, the other companies like in the technology sector, like Apple, establishing some form of momentum in the space. So we got to see how the market responds to that. And there are other technology stocks that will also be announcing earnings in the next few weeks. Basic materials, this is where the commodities are, especially if you look at gold and you look at copper and you look at steel and everything else. That one, we can see that had a descending triangle breakdown from 97 to 90.3. That's a $7 pullback from 90 is 83. It actually met that target. 83.34 was the descending triangle. So it is 97 to 90 is $7. Subtract 7.90.35, that's 83.35. But it met below it at 83.04, but a lower low in price, higher low in RSI is classic positive divergence. Higher lows in MACD histogram, positive divergence. This is kind of bottomed. So basic materials look for, it has since then recovered and it's kind of about to test the declining 50-day moving average. But if it can take that out, it is going to hit resistance, because what was support before that basic material breakdown below 90 would be resistance. So maybe it might hit some resistance at 90 and then maybe pull back a bit from here. But right now it's trying to recover and come out of the bottom that it formed in the last a couple of weeks, we would say. And real estate XLRE, we know that because interest rates, 10-year yield in particular, has gone up a lot. Since that September 18th first 50 basis point cut, the 10-year yield has dropped from the yield has shot up, not dropped. The bonds have dropped. The 10-year yield have shot up from 3.6 all the way up to 4.8% recently. So that's a very, very big 120 basis point climb in 10-year yield. 30-year yields as a result have shot up above 7%. Mortgage industries got hit. XLRE, which is one of bunch of those stocks, has broken down from its descending triangle pattern. 42 to 45 is a $3 move, that is around 39, which it tested successfully. Similar kind of bullish positive divergence pattern with the bottom happening. Lower low in price, higher low in RSI, higher low in MACD histogram, indicating that XLRE is likely formed a near-term bottom and trying to reverse higher. So when you're seeing in 39 to 41, it's kind of forming call it a resistance level, 40.9, 41. So that's about where the resistance is. A $2 move, maybe a pullback from here, and then breakout back to 43 is where we can expect. But we can expect the 50-day declining around 42. We know that the breakdown of the descending triangle was 42. We can see 42 tested multiple times. So 42 to 42.3 would be resistance for now. So we could expect the XLRE to climb up to there and then maybe take a breather. Finally, healthcare XLV is also call it a defensive sector. This is where the large pharma stocks are, the healthcare companies are. It has not yet met its pattern or its target for its descending triangle. So this descending triangle is from 144 to 158. That's a 14-point difference. Subtract the 14 from 144, that takes to 130. It has not quite met. It went to 135.33, came within 5 points of that target. But then since it's trying to form an ascending triangle reversal, so higher lows and resistance level at 142. So if this breaks back above that ascending triangle, then that could measure from 135 to 141. That's roughly 6 points. Add to the 141, close to 147, 148 is where this could. So this is something for us to watch. Will this be able to break the ascending and move back to 148, or will this fail and retest or actually test the target of this descending triangle? So as I said, 144, 158 is 14 points. The target is near 130, 131. So potentially we could watch and see if this fails here and breaks down to 130, 131, or can it break higher and back to 147. And then staples is where really, the Procter and Gamble's and all the kind of call it the essentials of what people need to buy day in and day out, no matter what the economy does. That has also a descending triangle breakdown from somewhere around 78.9 to 82.67. That's roughly $4, which measures down to 74.9. We can see 74.9, 74.8 is the level of support in the past from where it broke higher. I wouldn't be surprised to see this also have some more downside and perhaps test that target near 74.9. For the time being, the last couple of days, it has tried to reverse higher. We can see RSI slightly moving back above from 30 to 38. MACD, the PPO histogram is about to cross above zero. So there is potentially a possibility that XLP, the staples, could get some upside and maybe retest its declining 20-day moving average near 77.99 or 78. And then maybe it could fall down and test that target again near 74.9. So if you're looking to go long staples, I would wait for a 74.9 entry. I'd expect maybe a near-term test of the declining 20-day around 78, and then maybe a pullback towards the 75, 74.9. With that, good luck investing next week, or this week rather. The week of the 20th of January is going to be very interesting with many key earnings expected, and with the momentum of the President Trump now back in the office for the second term. A lot of bullish momentum the market expects. We know that Bitcoin just retested and exceeded it slightly this morning in the euphoria of Trump's, big pro-Bitcoin presidency. It had touched 109 this morning from a 108 was the previous high. So perhaps a little bit of a sell-off early part of this week, and then maybe breakout higher. So we'll see how the market responds. Any sell-off would actually be a buying opportunity, in my opinion. So if we do get some form of a pullback, maybe 2 to 3% in the next few days, it's like, buy the rumor, sell the news kind of idea. Market has been moving higher about the optimism, bullishness about Trump's pro-economy presidency, but maybe a bit of a pullback after his inauguration and taking over office, and then maybe that would be a buying opportunity. Why? Because we talked about, in summary, summation index forming a huge key reversal, testing the bottom trend line, and as a result, we think that the market could be seeing, as we've seen in the past, several weeks of upside, which could take it to S&P in particular towards the top end of the trend line above 6,200. Good luck investing. Talk to you next week. Thanks.